Happy New Year, dividend stock investors. You know what I have right here? I am ringing in the new year with this huge amount of Tide laundry detergent. This is from Costco. This is the large amount, the free and gentle of the Tide product that I love so much. This one is produced by Procter Gamble. One of my favorite dividend stocks of all time, and one of the dividend stocks in dollar terms that has earned me the most amount of money in my investing career. Now, if we take a step back and we look at 2018, some of you have been around since then. You may remember that in 2018, I was buying a lot of Procter & Gamble stock. It was out of favor. I bought a huge tranche at $73. Right now, Procter & Gamble is trading at $164. I bought this for $73. It's now at $164, and I'm earning massive amounts of dividend checks, passive income from Procter & Gamble. But back in 2018, when I was buying this company, it was out of favor. Some of you on the channel remember this. Everyone was running from it. They didn't like it. It was trading with a low PE ratio and a high starting dividend yield. It was out of favor. But you know what I did? I rolled up my sleeves and I accumulated Procter & Gamble. And just a few years later, my actions at that time paid off handsomely. And what's so funny is when I look back at 2018, I look at that as one of the best investing and financial years of my life. Now, we're starting a new year right now in 2022. A lot of us right now are looking at the future with a little bit of uncertainty. A lot of us right now are coming out of a few years here which have been pretty crazy in our world. A lot of us right now, as we enter this new year, we're looking at mistakes of the past and wondering, hey, when am I going to turn that corner? What's ahead for me in the future? I'm here to say from my personal standpoint, I believe 2022 is going to be one of the best years of my investing career. And I think 2022 holds a lot of promise for everyone in the dividend stock investing community. And I'm telling you right now in 2022, I am accumulating really well-known household brands. I'm not buying Procter & Gamble right now because this one is trading at a rich valuation. But if you watch one of my recent videos, which I'll link to in the description below, I'm buying household names such as Johnson & Johnson, 3M, and Raytheon Technologies. Now, what's so interesting is right now in 2022, as I buy these stocks, am I going to feel instant gratification? No. Am I going to feel, well, maybe I will because I'll see the dividend checks right away. But other than that, am I going to see huge amounts of capital appreciation overnight? Most likely not. Are things going to be weird this year? Is there going to be a lot of bad news in the media? Yes, there is. But here's what I have to say. I believe 2022 is going to be one of the best years ever because we're not even going to realize it right now in 2022. It's going to be like Procter & Gamble a few years from now. I'm going to reflect back at this year and I'm going to be like, wow, Ian, what a great year picking up those world-class companies at value prices. And so I have a lot to cover in the video today. This is meant to be an inspirational, motivational video for the dividend stock investing community. I want to go through Procter & Gamble. I want to go through my case study analysis with this company. I want to go through some of their financials, and I want to share just a few high-level thoughts of how I look at the stock market and why I believe dividend stock investing is so wonderful from a metrics and financial analysis standpoint. Get ready, everyone. I have a really exciting video for you today. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first thing I want to do in the video today is share some pure motivation. Check it out on the screen in front of you right now. This is a comparison of Procter & Gamble, ticker PG, and the S&P 500 index. As you can see in this chart, over long periods of time, this household brand company, consumer packaged goods, has outperformed the S&P 500 because Procter & Gamble is in the blue line, S&P 500 is in the yellow line. You can see how well Procter & Gamble is doing. And what's so interesting is Procter & Gamble back around year 2000, it had a major correction. it was pretty much at par with the S&P at that time. And so a lot of people may be saying, hey, Ian, consumer packaged goods companies, they've only done well because you're looking at really historical times that aren't even relevant anymore. But quite frankly, around the year 2000 and beyond, those are very relevant times, even to the modern day. And so you can see over the last 21 years, Procter & Gamble has vastly outperformed the overall S&P 500 index. And so that's motivational point number one, because we have a lot of people in this community who love to invest in dividend stocks like myself, but there's so many critics saying you can't do well with dividend stocks. You're going to sacrifice capital appreciation. You're going to sacrifice your total returns. That just isn't the case. I have found in my personal experience with certain dividend stocks like Procter & Gamble, it is possible to keep pace with the overall market while having a disproportionate amount of passive income. And in the case of Procter & Gamble, it's actually outperformed the market over long periods of time. And so that's the first thing I wanted to start with today. The next thing I want to do is share some financial analysis of my experience with this company, because I've been spending a lot of time going through my records over the last few months. I like to spend about 2 hours per week now just updating records, looking at metrics, because it makes me a better dividend investor. It helps me reflect better. It helps me really see the future better, because by looking at the past, it helps me envision where I am going and why the future is so bright. And so as you can see in front of you right now on the screen, I have some metrics about Procter & Gamble. Now, by the way, if you're not on my Patreon yet, check out in the pinned comment below. I will share on there a link to my Patreon, and at the corner tier level, I have videos all the time that have similar case studies to this one. And I have a thriving community over there on Patreon with a lot of bonus value, including access to my portfolio, the percentage allocation to each of my positions. Now, as you can see on the screen right now in front of you, what is so exciting with Procter & Gamble is it's trading at $164 just a few years after it was trading at $73. And so based on the forward estimates, now these are 2022 and 2023. These guys are on a fiscal year. And so for 22, they're looking to come in around $5.92 in EPS, 23, 636. That places the PE ratio forward right now at a 27.83 for 22, 25.91 for 23. It's expensive, but it's priced for its quality. This is a quality position in the overall market, and so it's trading at a premium. I'm not necessarily buying here, but we'll get to that in a minute. I'm going to buy at least one tranche this year because I've made a mistake over the last few years that I want to share. Now, the dividends per quarter are 87 cents or $3.48 a year. This comes out to a starting dividend yield of 2.11%. Now, the payout ratio is 59%, and so that's not too high. It leaves some room for them to reinvest into the company, and it leaves some room to increase the dividend over time. Now, one thing I would point out is the 5-year dividend growth rate, compound annual growth rate on average per year is 5.39%. But thankfully, the last dividend increase they just did was 10%, and it was one of their largest dividend increases of all time. And so that was really promising that they are signaling to investors just how strong the company is. Market cap is just under $400 billion. Big company. Now, I want to share some notes. This is where things get really interesting. I was going through all of my records, and these are some of the notes that I took and the lessons that I learned. And so, first thing I want to say is I started buying this in 2011. I've been in it a really long time. My first tranche was at $60.93 per share. That was also my best tranche, best price I got. Now, my largest tranche, the largest amount that I bought at a single time was in 2015, and that was at $78.49. I invested another large amount, as I mentioned in the introduction today, in 2018 at $73.29. 2018 was a big year for me in Procter & Gamble. I saw value that year. I was averaging in. The first thing I want to say is between 2011 and 2018, you can kind of see a story unfolding here that it was in a range. It was in a range of 60.93 up to about 78.49 at least. That was the range in which I was buying. And we're talking about a number of years here. Number of years it went nowhere, but I kept the faith. I kept investing. And one of the best things about being a dividend investor is I have the patience to wait it out for 5, 10, 20 years at a time because I'm not looking even for this capital appreciation. I shared in the video today because most people watching care about this. I care about it because it shows me the company is doing well. If the company weren't doing well, it wouldn't be growing in share price. And so that's why it's so important to me. But what is so important to realize as a dividend investor, because we invest for cash flow, because we invest for those dividends, it's so much easier to wait out extended periods of time where a stock goes nowhere. I'm buying 3M right now. That stock's gone nowhere as long as I've owned the thing. And it's been a while now. Shout out if you've been here since those early days when I first opened my position in 3M. It's one of the positions I covered quite a bit here on my YouTube channel. I have the patience. And so that's something so exciting about dividend stock investing. I get so many comments all the time on my channel. Ian, you bought this stock last year. A whole year has gone by and it's lost value. Shame on you. 1 year is nothing in the scheme of things in investing. Just look at my Procter Gamble case study. I let 7 years go by where it basically did nothing, but I just kept accumulating because I'm buying for the dividend, and I knew the share price over time would eventually get higher. And I look at the lower share prices as a blessing. But let's keep going. As you can see in front of you right now, the next thing I want to go through is when I look at raw cost, my dollar gain on Procter & Gamble is among the best in my portfolio. This is one of my top positions in terms of literally the amount of dollar value it's created for me and my family, thanks to the amazing shareholder-focused management at the company. Now, again, I want to underscore the next point. This is the one I just hinted at. I watched Procter & Gamble go from the 60s into the 90s, back to the 70s, and now it's at 164. But largely, between 2011 and 2018, so many opportunities existed to accumulate. And I'm sure during all of those years, there were so many naysayers saying, this stock is no good, look Ian, it's gone nowhere, you made nothing. And if I listened to them and sold this thing, I would have made nothing, or even worse, I would have lost money, and I would have foregone one of the companies that has created a tremendous amount of dollar value for my portfolio. And that's why I don't listen to the haters. And so as you can see, I got to share more. Check it out on the screen right now. The next thing that's so exciting is my true dividend yield on cost is 5.79%. The way I calculate this is I look at all of my dividend cash flow coming from the company. I divide that by the amount of raw dollars I invested. And when I look at raw dollars invested, I'm not looking at dividends reinvested. I am reinvesting all dividends, but I look at that as free money. This is not a tax calculation. For taxes, you look at those dividends reinvested as part of cost basis. But for understanding true yield on cost, I look at things a little bit differently, and my true yield on cost is 5.79%, not the highest in my portfolio, and largely that's a function of the fact that their compound annual growth rate on that dividend is only 5.39%, but I do have the faith over very long periods of time. My true yield on cost will easily surpass 10%, which would be amazing on this company. And my gain on my money invested, and mind you, this is not money invested in 2011. This is all the money invested. And I had mentioned before, my largest tranche was in 2015. My other huge tranche was in 2018. These are recent years. My percentage gain on money invested, again, dividends invested or reinvested or gravy, that's free money. The way I look at this is the value of my position now as compared to how much money I put in, not including reinvested dividends. I'm up 174%. 174%, and that echoes the chart that you just saw earlier in the video comparing the S&P to Procter & Gamble. And now I want to share a mistake. The last thing I highlight on the screen in 2019, 2020, 2021, other than reinvesting dividends, I bought no net new tranches. I think a lot of this was because I bought so much in 2018 and I wanted to refocus on other things. But I would say a lot of this also was just losing focus. I lost focus of one of the most important companies in my entire portfolio. I lost focus of the goose that laid the golden egg. I have to look at myself critically as an investor, and I've done a lot of things right, but I've made a lot of mistakes as well, and I want to share those mistakes on the channel as well. And what I'm really striving to do in 2022 and beyond is to add to my core positions like Procter & Gamble at least once per year. I cannot let years go by when I miss a company like this. It just ain't gonna work. And with this one, I let 3 years go by. It's unbelievable. That being said, even not adding to the thing in the last 3 years, it's one of the absolute largest positions in my portfolio, which just speaks volumes to what management is doing at this company. And I don't have to invest in technology to have these kind of results. I'm investing in a consumer packaged goods company. Now, I want to talk about Max Drawdown for a little bit. There's this concept out there. I thought it would be interesting when looking at Procter & Gamble. It's one of the great performers in my portfolio. It's done really well. And so I started thinking, hey, I imagine during major market corrections, it's outperformed the average, the S&P 500. And I started looking at the data on the internet. I want to share with you what I found because it actually surprised me a little bit. This is one thing I'd say about my investment here, that more or less it has just as much volatility as the index. That being said, maybe it's not fair to compare a single company to an entire index. When I certainly look at my entire dividend portfolio, all of my stocks, 49 dividend stocks, I have 6 non-dividend stocks. When I look at the 49 dividend stocks, basically the max drawdown for all of those tends to be a lot less than the index. But when I look at just Procter & Gamble, it's comparable to the index. Anyway, as you can see in front of you right now on the screen, I want to show something I found on a website called Portfolios Lab. If you haven't checked it out, this is a really cool website. You definitely want to take a look. They show the worst drawdowns for PG. And basically the worst one was in 2014. It had a max drawdown of 25.46%, meaning from the peak to the trough, 25.46% of shareholder value was eliminated in that downturn. But you can see in 2020, it had a pretty big drawdown of 23.16%. 2017, not surprisingly, it had a big drawdown of 23%. That's probably why it's buying so much in 2018 because it had just suffered a correction. You can see another drawdown there from 2020, so on and so forth. So it's had some pretty bad drawdowns, but let's compare it to the index, to the S&P index. Certainly none of those have been above like 30% or more, and so it was nice to see that at least. But it's had some pretty big ones there in the 20s. But as you can see on the screen in front of you right now, I want to look at the same website, this Portfolios Lab, and I want to look at it for the S&P 500. And what you see there is the worst drawdown for the S&P was 33.72% in February of 2020. But then it had a drawdown of 19.35, 18, so on and so forth. What's interesting about the S&P is the worst drawdown was worse than Procter & Gamble. But it seems like not looking just at the worst drawdown, but kind of all the others, like looking on average, it had a lot of drawdowns in there, which honestly weren't as bad as Procter & Gamble. So what I did next is I put it all into Excel to run a little analysis. And as you can see in front of you right now, you can see all the drawdowns right there in Excel. And so what you have is on the left-hand side, Procter & Gamble drawdowns, right-hand side, S&P drawdowns. And what I do is I just average them. On average, if I look at all these drawdowns for Procter & Gamble, I get a minus 15.01% on average. If you look at all the drawdowns for the S&P, minus 14.5. And so honestly, I thought Procter & Gamble would be a lot less than the index. When I look at it this way, I would basically say they're somewhat on par. And I would say Procter & Gamble has had more of kind of heavier, kind of a concentration of heavy drawdowns, but the index had the worst drawdown at that 33%. What I would say, though, again, maybe I can't compare the two because I'm comparing a single stock to the index, but what I'm trying to tell the community is sometimes with dividend stocks, they can be a little volatile. And I think, quite frankly, with something like Procter & Gamble, perhaps it's volatile because its performance has surpassed the index. And with any kind of performance like that, when something is going up so much, you're going to have corrections along the way. Now, thankfully, this tells me two things. One, because it's a dividend stock and it pays a lot of dividends, that comforts investors during drawdowns. Two, what all this should tell me and you at home is for those of us that buy world-class dividend stocks that have conviction in what we're buying, we can rest assured that despite all of these drawdowns in the past, this stock and the index, quite frankly, have marched on to do great things. Now, I want to take a pause here and ask you all a favor. If you're at home and you enjoy this video today, one of my goals this year, and this has been a goal the last few years, but I have not reached the goal yet, is to reach 100,000 subscribers. If you could take a moment and please click that subscribe button with the notification bell. It would mean the world to me. And while you're at that, if you don't mind, please go ahead and smash that like button. This is a New Year's gift that would mean a lot to me. I want to see if I can reach 100,000 subscribers this year in 2022. I am not going to give up on that goal. I am grateful for your support. Now, I want to move on with some more analysis. So as you can see on the screen right now in front of you, I wanted to look into the S&P 500 just a little bit more to share some philosophies and overall insights on the stock market and how I like to invest. Don't worry, I'm going to get back to Procter & Gamble a little bit later. I want to go through their annual report and some of their cash flows. But first, what I want to show you is some information on the screen right now from Vanguard. Vanguard has an S&P 500 ETF, and it shows the top 10 largest holdings. And you can see right there, Apple, Microsoft, Alphabet, aka Google, Amazon, Tesla, Nvidia, Meta, Berkshire Hathaway, so on and so forth. Home Depot is on there, thankfully, which is one of the stocks I own that has been one of my absolute best performers as well. And I love that company so much. Now, the reason I'm showing this to you is we looked at Max Drawdown, but when we look forward towards the future, by the way, I own Apple as well. It's done very well for me. Now, but when we look forward to the future, we start thinking Max Drawdown. Past performance is not necessarily indicative of the future. I know we have a lot of investors here on this channel who are looking to minimize volatility in their portfolios. I'm one of them. When you look at this, I just kind of think going forward, owning companies like Procter & Gamble and all the types of companies I love to own, like Home Depot as well, and I do own Apple, I generally believe that my portfolio is going to allow me to sleep a little better at night than owning the index, which has such a heavy weight in these types of positions. And this is further exemplified when you look at the equity sector diversification in the top left here. You can see that communication services, which is technology related, is 10.4%. And you can see that information technology is 29.3% in the S&P benchmark. And so basically the S&P, in my opinion, has a good, say, 40% in tech and only 5.6% in consumer staples. But if you've seen my portfolio, you know my name is PPC Ian, but I could also go by CPG Ian because I'm so focused on consumer staples. And so that's just something, I thought that was an interesting insight. Now, some of you at home may think I'm putting myself at risk because I'm too overweight on consumer staples, and maybe these staples are disrupted by white label brands like Amazon brand, for example, store brands. We shall see. So far, things have worked out pretty well for me, and companies like Procter & Gamble continue to make acquisitions and innovate to stay ahead of the curve. And you're going to see some of that in a minute. It's really exciting with their earnings report. And so with all of that, I have another screenshot, as you can see in front of you right now. The next screen that I want to share all of you is more Vanguard. And you can see here they show you the percentage in Vanguard of each of these holdings. By the way, Johnson & Johnson, one of my favorite stocks of all time, is now larger than Home Depot, and so I don't know why Home Depot's here and J&J is not. Perhaps this snapshot is from 11:30. For a moment in time, Home Depot was a little bigger in the index than J&J. But you can see here, just from a percentage standpoint, 10 largest holdings in the S&P make up 31.4% of the S&P 500 index assets. And so I think that's really important to just keep that perspective in mind. I visit this slide, I visit this information from time to time. I think it's so important to refresh that because we do have a lot of index fund investors in the community here. And I have nothing against index funds. I think index funds are awesome, and different strategies can work for different people. There are so many ways to invest in the market. I'm just sharing my personal journey and perspective for fun and entertainment. But I want to shed some light on that a lot of people who invest in the index, they may not realize how much emphasis the index has on these top 10 holdings and on the information technology space. Now, with all of that, I want to keep going. I have some more insights that I want to share with you as it pertains to the annual report from Procter & Gamble for fiscal 2021. So as you can see on the screen right now, this is a summary from the annual report from fiscal 2021. And it was so amazing to read this on a number of levels. One, organic sales growth is doing really well up 6% year over year, core EPS 11%, and their adjusted free cash flow productivity is 107%. We're going to get to that in a minute. I think the last number, quite frankly, is my favorite number out of all this, or one of my favorites, but I love that number, and I want to explain what that means to all of you in a minute when we go through their statement of cash flows. And so what's so exciting is organic sales were up 8% in the US and 12% in Greater China for the fiscal year. And it shows that this is so key. E-commerce sales were up 35% for the year and are now over 10 billion in sales, representing 14% of total company sales. And so Procter Gamble is clearly a company where they did not miss out on the trend of the internet and e-commerce. I think they have a lot more they can do, but they're doing really well there with 14% of company sales coming from e-commerce. And their market share is increasing. Now, this is so important. You can see here in bold, not only bold, but in blue, but in a larger font, almost a headline font. Our quarterly dividend increase of 10% in April of 2021 was the largest increase in over a decade. They go on to say below that, we returned 19 billion of value to share owners through 8 billion in dividends, 11 billion in repurchases. And mind you, they're doing repurchases, in my opinion, more or less the right way because cash flow is strong. On any given year, maybe they're digging into debt for that, but I would say on average, cash flow is good. We're going to look at that in a minute. They announced 10% increase in the dividend. It was the 65th consecutive annual increase and the 131st consecutive year in which they have paid a dividend. This is the kind of company that I like to own. They take the dividends seriously. They care about shareholders. It's so important to realize that dividends, they're not just for executives. Dividends, they're not just for people with a lot of money. Dividends are for everyone. They can help anyone become financially free. They can help anyone just improve upon their finances. And so many of us were heading into 2022. The last few years have been crazy. If you're stressed out, if you're considering what are my financial options, dividends, in my humble opinion, provided by companies like Procter & Gamble that care about shareholders are so amazing. They're such an amazing component of that, what I like to call the sleep well at night factor. These are the kind of companies I like to own that bring a lot of value to my finances and to my security and my ability just to live a less stressful life. All right, everyone, I want to share something else. As you can see on the screen right now, the next thing I want to go through is the statement of cash flows. And one of the most important points that I want to make with this analysis right now is that net earnings is not the same as cash flow. But you can see from Procter & Gamble that net earnings in 2021 were super strong. They came in at 14.352 billion for the fiscal year 2021. But you can see that the company makes a number of adjustments onto these net earnings to arrive at a true operating activities cash flow of 18.371 billion. So that's the true cash flow that the company had from the year from operating activities. And the biggest add back that you have there is they added back depreciation and amortization because that's not a true loss. Although for GAAP earnings, it's subtracted out before net earnings are announced or reported. And so that's why they add it back. You can see another big line item is changes in accounts payable, accrued, and other liabilities. They adjust for that. It's a big add back of 1.391 billion. Long story short, they're coming in close to 18.4 billion or 18.371 billion in the true operating cash flow. Now, what's so important though to realize in all of this is in the next section of the statement of cash flows, we have investing activities. And in investing activities, one of the biggest items that you need to look at is called capital expenditures. Capital expenditures is when a company needs to take money and make improvements to their plants. They need to buy new equipment. They need to make investments in their operations, in their production, for example, to build whatever widget they're selling, or in the case of Procter & Gamble, that Tide laundry detergent. And so you can see in front of you on the screen right now that each year they have capital expenditures, but CapEx is not incorporated into GAAP EPS. And so a lot of companies have a lot more CapEx than you would think, and that's why it's always important at a bare minimum before investing in any kind of stock is to look at the cash flow statement and to understand how much CapEx they have ongoing. Because CapEx, it's not a one-time thing. It's recurring for any business. You see it yearly, each year here for Procter & Gamble. But what's so exciting is it's only $2.787 billion. And when you adjust for that, they're still earning in terms of cash flow more than the net earnings. So I'm going to get into that in a minute. I did a little Excel worksheet on that. But before I do that, before I close this screen, you can see a few more things here. On financing activities, you can see the dividends there. You can see that they made a reduction in short-term debt. You can see they made an addition to long-term debt. You can also see they made a reduction in long-term debt. You can see some stock repurchases, so on and so forth. You can actually see for the entire year they had a negative change in cash all the way at the bottom. And I would say, well, maybe they went a little bit too strong on those treasury stock purchases, or maybe they paid down a little bit too much debt. Who knows? But that can fluctuate year to year. I don't get too crazy on that 1 year at a time, because you can see in the prior year, it was a positive 11.9 billion. In the year before that, 1.6 billion. So it can fluctuate year to year. However, what I want to share with all of you out of this is I'm trying to explain that number they were sharing in their annual reports. So now, as you can see on the screen, I want to go back to Excel. And so net earnings were 14.3 billion. Cash from operations, we know, was 18.3 billion because they had to add back in a bunch of stuff. They also subtracted some stuff. They adjusted for the true cash from operations. We know CapEx was 2.787 billion, so I subtracted out. What was their cash from operations minus CapEx? It was 15.584 billion, which is still greater than net earnings. If I take that and I divide by net earnings, I get 108.6%. Now that's a little bit higher than the 107% free cash flow conversion number that they gave on the annual report. But I believe the reason for that is they're paying interest on their debt. I didn't factor that into my analysis because it's hidden there in the statement of cash flows. I'm sure somewhere else in their annual report I can find that interest payment, but that's why my number is a little bit different than the free cash flow conversion that is showing up in their top level in their annual report. But I wanted to give all of you at home a glimpse of how I look at these statements, what these numbers mean, why they're important. Long story short, the bottom line here, Procter & Gamble is a strong company and they have a really strong free cash flow conversion. And so they are not getting burdened or bogged down by capital expenditures or something else wacky on their statement of cash flows. And so if you enjoyed the video today, everyone, let me know in the comments below and let me know what you think about Procter & Gamble. Do you like this company? Do you not like it? Let me know if you're going to be buying any this year in 2022. I sure am. And if you enjoyed the video today, please go ahead and smash the like button. I really want to see if on this video, perhaps we could get over 1,000 likes. Let's see. And Happy New Year, everyone. Please don't forget to subscribe. And again, in the pinned comment below, I'm going to share my Patreon where I have a lot of bonus resources and I share all of my stock trades there at the backyard level and corner level. And at the corner level, I have even more. I have bonus crypto content. I have my portfolio percentage allocations to the different positions and bonus videos at the corner level as well. Before we leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long Procter & Gamble, ticker PG, 3M, MMM, Johnson & Johnson, ticker J&J, Raytheon Technologies, ticker RTX, The Home Depot, ticker HD, Apple, ticker AAPL. I own those stocks in my personal dividend stock portfolio. And before we leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose a ton of money in the stock market. It is very risky. I'm just sharing my journey here on YouTube for fun and entertainment. All right, everyone. I love you all. Happy New Year. I'll see you in the comments below, and I'll see you in the next video.